Good evening. This is Nanama Pokua Tete, the fund manager. Um, Today it's another part of my videos, just a short one. And today want to talk about bonds. It's also another type of investment that you could put your funds in. So bonds, these are typically known as fixed income or fixed income securities. Most of these, the purpose of these bonds are they could be issued by corporates or governments. They're issued to raise some funds to invest in the company, to new products, or to invest in a community, or for the government to invest in to carry out its infrastructure activities. Typically, the types of bonds you can have corporate bonds, which are issued by corporates, companies, both private and public companies. You could have treasury bills or treasury bonds or gilts. These are issued by governments. And then you could also have municipal bonds. These are issued by local authorities or states or not the central government, but well, yeah, somewhere down. Corporate bonds have quite high yields, but then they are also very high risk. Issued by private companies. The companies also typically have very good ratings. But then, well, I wouldn't say all companies have good ratings. It's a mix. As compared to treasury bills, which have quite low yields and very low risk, which are quite low risk, I should say. The coupon rates are quite low as well. But then with that one, you have the guarantee that you will get your money back. It's backed by the US government or the UK government or any other sovereign entity. You also have municipal bonds, which are, as I said, are issued by local authorities or municipal assemblies. Again, these are also quite low risk, and they are backed by the full capabilities of the local authorities. With bonds, you could have some of that income. So they pay an income. Typically, they would have an income paid on them with most bonds. With municipal bonds, you could have revenue, ones that are linked to revenue. So it will be linked to a project that is revenue generating. So the revenue generated out of that project will be used to pay the bond. And you could have some that are not revenue generating. Ratings, you could have very high rated bonds, typically investment grade, above the C grade by credit rating agencies, or you could have very low rated bonds, which could be very junk bonds, or these are sub investment grade bonds. They come with a higher risk. If you have a low risk appetite, then you might want to avoid bonds which are low risk. The other types of bonds you could have are mutual bonds or bond funds. So these are funds whose underlying assets are individual bonds, or maybe are more skewed towards or heavily weighted towards bonds. And you could have junk bonds as well. These are really sub investment, really low grade, very high yields, but then you could lose your money. They could default, the issuer could default easily, and you could lose your money. So again, I mean, you can make good money out of it, but then you should always be aware that junk bonds can easily be defaulted on. And the other thing on bonds is the tips to invest. When you're investing in bonds, you should know when your bonds are maturing. So is it 10 years, is it 5 years, is it 2 years? It's good to know, at least you know how much income you're getting, and also when you can redeem the principal on that bond. You should also know the bond rating, because if it's high, it's low, again, knowing that, and also knowing your own risk appetite would enable you to match which type of bonds to go for. And also, it's also good to investigate the issuer's track record. I mean, have they defaulted on any bonds? Do they pay it on time? What's the history of past bonds that they've issued, etc., etc. You also need to factor in macroeconomic risk, interest rates, inflation. If interest rates begin to rise, then your bond becomes worthless because people will be moving money into other more better paying assets or better returning assets. Inflation might also erode the income that you earn on your bonds. You also need to think about the broader investment objective. So why do you want to invest? If you're closer to retirement, you might want your risk. You might need the income much quickly. If you're much younger, not closer to retirement, the income might not really be an objective, and you might more be interested in capital accumulation. So again, you might be looking at maybe low risk versus high risk, or low yield versus high yield, or you might even want to go into other type of assets. So you just need to think about everything. You need to read the prospectus carefully. Obviously, it's quite long, but then you need to understand the company, the aims of why they're issuing the bonds. I mean, what do they already have? How much leverage do they already have in place, etc. As much as possible, it's advised you use a specialized broker for these things, given bonds are quite complex. And then also, it's important to understand the fees and commissions. Yes, it's all well to buy, but then you need to understand the costs, the overall cost of buying and holding that bond. Another area I want to talk about. Probably I'm going to end here today. It's 7 minutes, and I think I'll continue. The next time I'll talk about the benefits of investing in bonds, and then also the risk associated with investing in bonds. Thank you very much today. As always, if you have any questions or if you have any contributions, do email me amapoks1982@gmail.com. Thank you.